Bloomberg Audio Studios. Podcasts, radio, news.
I have another piece of information that can't be used in the podcast.
We'll say it in front of the microphone.
There's a dead possum in my backyard, and I'm trying to pretend that I haven't noticed it so that I don't have to...
Matt, that gets worse by the hour.
I know. The thing is...
Wait, we can't put this in the pod?
Well, because then my wife would hear it.
Does she listen?
Sometimes.
That's cute.
So one day I noticed a dead squirrel in my yard, and I was like, ugh. And then I forgot about it, and I came back the next day and it was gone. There's a fair number of birds of prey in my vicinity, and I was like, good job, birds of prey.
So you're just hoping one of them gets the job done?
But this possum is now past his expiration date.
By birds of prey, you most only mean vultures, because I don't think a hawk would eat. Okay.
There's loads of vultures in my neighborhood. Right.
Ew.
But no, we see bald eagles a fair amount, and the bald eagle, famously a scavenger.
I feel like I did know that actually, but I had
It's like Ben Franklin's whole thing. He wanted the national bird of America to be the turkey because the turkey is a noble bird and the bald eagle is a scavenger.
It kind of reminds me of when my cat vomits in my apartment, and I pretend not to notice it until my husband does, and then he cleans it up.
Hello, and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Speaking of dead things.
The death of a multi-strat.
Yeah. So there's a big story this week about Edward Eisler's multi-strategy hedge fund, which is called something like Eisler Multi-Strategy Hedge Fund.
Something along those lines.
Is winding down because it's hard out there for a multi-strategy hedge fund that is not one of the big four multi-strategy hedge funds.
Yeah, this is a great scoop from Bloomberg. I did enjoy also the postmortem written by Sarah Butcher over at eFinancial Careers, which spoke to a bunch of people who had worked there or were familiar with it. And I don't know, you add the two articles together, it seems like a lot of this just comes down to costs. Also, returns weren't great.
Yeah, the hedge fund market has gotten so much more efficient in my time. It used to be that if you wanted to start a hedge fund, you started a hedge fund and you got capital based on your track record, but also your ability to appeal to LPs and what was in style and what institutional investors were looking for. And now increasingly, the hedge fund business is dominated by these big multi-strategy funds like Millennium and Citadel and Point72. And if you are a person who wants to run money, you probably end up going to work for those guys rather than going off on your own. And to run money for those guys, you don't have to be good with LPs. You don't have to be necessarily in style. You're just doing a job at a big firm. And so as the market gets more efficient, the people who are good at those firms get handed huge piles of capital to trade. And it's just harder and harder to work outside of those institutions.
Yeah.
And in particular, it seems really hard to run a multi-strategy fund.
Yeah. I feel like just the story of Eisler in general is a sign of the times in two different ways. Because it didn't start as a multi-strategy. It started as just a single manager fund. Then it pivoted to become a multi-strat in 2021. And now it's winding down because it's not Millennium or Citadel, to oversimplify it.
Right. One of my readers emailed to be like, his mistake was pivoting to being a multi-strategy fund. When you're a single manager fund, you have his own skill, which is what allowed him to launch a hedge fund. And you have much more ability to evaluate the people you're hiring because you're kind of hiring them to assist you in making calls that you have a good understanding of rather than hiring them to stand up an entirely new business under your umbrella. My headline about this was something like hedge funds have to be big. And that's not really true, right? There's still a market niche for people running single manager specialized hedge funds. But it's probably true that multi-strategy hedge funds have to be big, right? So if you're going to pivot from being a single manager fund to being a platform for a lot of portfolio managers, you have to be a big platform because otherwise they'll go to somewhere that can give them more capital and more money. I don't know why he pivoted, right?
Yeah.
And clearly there is some pressure to pivot. Even if you run a single manager fund that has a good track record and is really good at its specialty, you're still going to feel kind of squeezed by the big multi-strategy funds that have more resources and are like an easier check for big allocators to write, it's like harder to compete with them. And so you might think, well, the best way to compete with them is to be a multi-manager fund myself. But that's a big bet. You have to become a giant multi-strategy fund to really compete.
Instead of getting even better at your thing, you spread out across all the things.
Plus, like, by the way, all the people who run the big multi-strategy funds, like, did kind of start as, you know, hedge fund managers, and then they became managers of hedge fund managers, right? So there is a path, right? It's just, it's not clear how many people can follow it anymore.
Yeah. I don't know if I would pivot my hedge funds that I run to become a multi-manager fund in this day and age. I do want to talk about fees, because that's a recurring theme here, is that the pass-through expenses at Eisler were really high and they were trying to bring them down. And are pass-through fees unique to the multi-strategy dynamic?
Yeah, the modern multi-strategy funds are somewhere between a hedge fund and a fund of funds. They're kind of like, their business is to hire portfolio managers, allocate capital to them, and sort of pay them like hedge fund managers, and then collect fees from the ultimate investors. And so, yeah, the pass-through fees are traditionally a hallmark of modern pod shops, because like what a pass-through fee is, I mean, it's like paying for rent and Bloomberg terminals and stuff.
Right.
But really what it is paying performance fees to the individual portfolio managers, regardless of the performance of the overall fund, right? So like when you're hiring portfolio managers, you can pay them incentive compensation on their own performance. And I think in the current market, you pay them like accelerated performance compensation on their own performance. So you pay them like a bigger chunk. If the going rate is they get 20% of their profits, like you might pay them 30% for their first year so that they like have an incentive to join you, because it's like a really hot market for hedge fund talent. And if you're doing that and you run a big fund, you have some economies of scale and you have some offsetting, like you have the ability to like aggregate a lot of good portfolio managers into something with like high and uncorrelated returns. But you have a big expense base. And if you are a smaller fund, it is harder to spread that expense base over a lot of winning bets.
Well, you think about some of the figures that Nishant Kumar wrote about. So the firm charged clients $244 million in pass-through fees in 2023. It was about $200 million in 2022. They had a restructuring earlier this year and were trying to bring their pass-through fees down to 2022 levels. But then you pair that with the Sarah Butcher article, and there are some snarky quotes from people who used to work there about how a lot of their real risk takers had left, like their hotshots. And they just had, this is a direct quote, they had far too many junior people who didn't know how to take risks. So it seems like their costs were really high for at least what's being described in this article as subpar talent.
Well, this is just like the efficiency of the market, right? Like this is what Cappy Paleologo said to us on the podcast, like that the funds that he works at are sieves for talent, right? Like you have the big funds are pretty good at identifying talent, pretty good at firing people who they don't think are talented. And so they end up with a lot of the good portfolio managers. And if you're a good portfolio manager at a multi-strategy fund, your name's not on the door, you're kind of doing it for the money, right?
Yeah.
Like if someone is like, we'll allocate you more money and give you more of your performance as a fee, then, you know, you end up at the bigger places that can allocate you more money. And if the bigger places are really good at identifying talent, that's how the talent sieve works. And that makes it really hard for someone who runs a smaller place to keep the best talent.
There was something in the article about how a lot of the meeting rooms after this letter went out were filled with people calling headhunters, et cetera. Apparently, some insiders noted that Eisler's more mediocre portfolio managers will now simply fan out across the industry and dilute returns elsewhere. That's just so brutal.
I don't know why that would be true. I mean, I don't know.
You think they're going to leave altogether?
I wish the best to all mediocre portfolio managers, but it's the talent sieve, right? Like,
yeah.
Like, no one's like, ooh, let's scoop up the mediocre portfolio managers, right? They're trying to find the people who have good returns.
A lot of these Eisler employees were calling headhunters at the start of the week. They could have been calling, actually, their new agent.
Okay, so there's this Wall Street Journal story about this guy, Ryan Walsh, who is, I think, has styled himself as the first talent agent for hedge fund managers or for portfolio managers.
I've certainly never heard of one before. But
haven't you, though? Because you've heard of recruiters.
I've heard of recruiters. I've heard
Are
of
they
headhunters.
different?
They're a little bit different in terms
Say
of
how.
who's paying.
Yeah, okay.
I said it.
Yeah, all right.
Do you think they're not different?
Do you think they're different?
I think they're a little bit different.
Yeah, they're a little bit different. If you call a headhunter, the headhunter will, one, try to find you a job at a hedge fund, and two, try to get you the best possible compensation package because probably they get a cut of it, you know?
True.
Now,
but that cut isn't coming from your paycheck.
no, right. It's coming from the hedge fund, which is so right. A traditional headhunter is probably more aligned with the employer, whereas an agent is more aligned with the employee.
They should be, shouldn't they?
They should be. But both of them are mostly interested in brokering a deal rather than like...
We're all trying to eat, you know?
Yeah. So, I don't know. My point is that like a hedge fund agent is not so different from a hedge fund recruiter, but it's a little different.
There's nuance.
There's nuance. And this guy is apparently the first hedge fund agent, but possibly the first one to have a work of art featuring Ari Gold, the agent from Entourage, on his walls.
Yeah.
You know, you like watch, like, you know, some number of people are like watching Entourage, like, ooh, I could be an agent for hedge funds. I don't understand. But so this is what I think about hedge fund agents. Like, you think about like agents classically, it's like sports, actors, television anchors,
For sure.
things of this nature. It's like traditionally people whose day job is not financial negotiation and like possibly somewhat unworldly, right? Like you think about like a quarterback is not like a business person. They're like, you know, they're throwing a football. They're not like thinking about business all day. It's funny to have an agent for like a hedge fund manager who like, I would think that if you're a portfolio manager at a hedge fund, you actually do have a pretty good sense of the market for portfolio managers at hedge funds in a way that,
that's true.
You know, a novelist might not.
That's true.
You just sort of like as a matter of temperament and personality, you'd pay attention to those things and you'd like be able to discuss the value of getting a higher percentage of your profits versus an upfront. You know, like you'd think about related topics all day and you'd be keenly interested in this. So you would probably have less need for an agent. But as the guy points out, like you do have a demanding day job. And so you probably aren't closely tracking the market for portfolio managers. And like the market is not super transparent. So like you're relying on rumor and anecdote to know what people are getting paid elsewhere. And so if there's an agent who collates all of that information, he's going to provide value to you.
Also, the idea of someone negotiating on your behalf and like someone...
Again, yes,
Yeah.
I agree. I would want someone to negotiate on my behalf. It's possible that a lot of hedge fund portfolio managers are happy to negotiate.
I don't know. Maybe
if you're like
they
a distressed guy, you're like, yeah, I'll curse at my boss.
Maybe you just want to sit in front of your Bloomberg terminal or whatever and think your big thoughts.
No, I agree. I think there's a range of people, and there are certainly a lot of people who have killer instinct as like electronic traders, but don't want to negotiate with their boss for more money.
Yeah.
And so they can hire an agent. Reading this article, I also thought about like, you know who really should have agents?
Tell me.
AI researchers.
AI
who
researchers.
They check all the boxes. First of all, they get paid like an order of magnitude more than hedge fund portfolio managers,
True.
which is crazy. Second, they are like stereotypically kind of unworldly. And like there's been like articles about like, oh, like these 23-year-old AI researchers are consulting with their friends
no
to see
experience.
see whether they should take a $250 million offer from Mark Zuckerberg. They should have an agent.
Yeah.
I should be it. I mean, I shouldn't be because I'd be
you
terrible
could
at all aspects of that job.
Yeah, but you'd probably be slightly better than that 23-year-old.
I'm not sure that's right. Because like ultimately the job is to like appeal to Mark Zuckerberg.
That's
Maybe
true.
he likes the 23-year-old.
That's true.
More than he'd like an agent.
It's not even like cold calling. Your only call is to Mark Zuckerberg and trying to...
Right. It's a degenerate market. It's not like, it's not like, oh, this is what all the rates are. It's like, nope, this is Mark.
It is funny that the Wall Street Journal article mentioned that Their business is dependent on the scale and proliferation of multi-manager hedge funds and could dry up if funds suffer a run of poor performance or redemptions. And of course, we're talking about the death spiral of Eisler. And it's almost similar to the AI researcher. You know, you're calling up Mark Zuckerberg or you're calling up Izzy Englander or Ken Griffin. It's a slightly bigger pool, obviously.
It's an interesting question. Like this world that we live in of these like multi-strategy pod shops paying a lot of money and sort of dominating the hedge fund space is a relatively new world. And right, it's possible that it's a blip and all of this will dry up and something new will replace it. But it does kind of feel like this is the correct organizing model for the hedge fund world, where you have like these big institutions that can allocate a lot of capital to investors and measure their skill really carefully and maximize the fees they can charge their limited partners. It feels like it's a sort of correct and efficient organization of the hedge fund industry. And in that correct and efficient world, like agents will thrive, right? If like all these multi-manager funds blew up and we went back to a world of like single manager funds with the manager's name on the door, then you wouldn't need an agent, right?
Yeah.
Like you'd be a different thing. Like these hedge fund managers would need capital introduction, right? They'd need like to meet with LPs, but they wouldn't need to get hired by big firms. But I think the world we live in now, where the big firms hire the portfolio managers, feels kind of robust. It's not like just an accident that it's organized that way.
Yeah. No, it feels like it's a ripe space for agents to be in. And I'm kind of surprised that this is the first.
It's because there have been recruiters. Right?
Yeah, that's true. Well, it's cool that, he struck out on his own and styled himself as an agent versus just another headhunter.
Yeah. I mean, you see the appeal of a headhunter, which is the headhunter cold calls you at your current job. It's like, I'd like to get you a new job where you'd get more money. And I will take 0% of it. And this guy calls you and is like, I'll take a single-digit percent of it.
Yeah. Well, apparently he's doing well.
The pitch of I will take a single-digit percent when the number is very large is actually pretty appealing, right? Yeah. It's like, I'll negotiate on your behalf. I'll work for you, not for the hedge fund. Like, I don't know. That's an appealing pitch if the numbers are large enough.
Yeah. Also, single digit, not bad.
Yeah.
So he founded this shop, according to LinkedIn and this article, a year ago, October 2024. He's helped 12 clients land jobs in deals worth a combined $180 million since launching. So
not the top of the top end where like individual deals are $50 or $100 million, but like pretty good. It's like a 15 million average ticket.
And maybe those people will, their next jobs will be bigger.
Yeah.
Yeah. Good on you, Ryan Walsh. I love football. And so do folks on the prediction market that is Kalshi.
I do love that Kalshi, which is simultaneously a sports book and not a sports book. They advertise like...
You need to throw in a wink there.
Simultaneously a sports book and not a sports book. Yeah, they like advertise on Instagram like, the only legal sports gambling in all 50 states.
Careful.
And then they're like, we don't do gambling. But this has nothing to do with gambling.
Yeah.
The other thing that makes them unlike a sportsbook is that they don't license like the NFL's trademarks. So like you can bet on the Super Bowl, but it's called the Pro Football Championship.
The big game.
You
can't call it the big game.
The big game is controversial. I think at some point the NFL tried to trademark the big game. Yeah, it's great. In any case, Kalshi will allow you to bet on the pro football competitions. And the latest news in Kalshi is that they are now offering same-game parlays. We talked about this on the mailbag episode. Prediction markets come out of this like high-minded idea of like, we're going to have these prediction markets that produce information about geopolitically important events, right? We're going to allow people to predict events, and it's going to provide more information for the market, and it's going to be great. And it's going to allow people to hedge the results of elections, right?
Yeah.
And it turns out that the demand for that is, like every 4 years you want to bet on a presidential election, but otherwise it's just not that hot.
It's like the Olympics.
Yeah.
You care about track and field once every 4 years, and then you move on.
Unless you're Kitty Greifeld. But all dressage and track and field at your ass.
Yeah, esoteric sports.
But it turns out that when you have a prediction market, one thing people like to predict is sporting events. And those happen all the time. And people are really addicted gamblers who put a lot of money into predicting sporting events.
Yeah.
And so if you can have your prediction market predict sporting events, then that's a big business. And everybody thought all of the time until this January that that would be crazy. And that obviously you couldn't have sports gambling in your prediction market. But now you can.
Yeah.
So now Kalshi does. And we've talked about like the regulatory drama where like the states all try to stop them from doing this, but Kalshi has so far succeeded in telling the states to buzz off. But anyway, so now they're offering same game parlays, which everyone who talks about this sounds insane, right? So like Robinhood is like, we're democratizing access to
an emerging
asset classes like sports predictions. But it's like the emerging asset class here is same game parlays, which is just like product for gamblers.
Yeah.
Like no socially beneficial information is created by people betting on like the joint odds of like a football team winning and hitting the over and like someone scoring a touchdown. To self-certify these contracts, to like allow Kalshi to do this, they don't have to get approval from the CFTC, but they have to like file a form with the CFTC being like, we're doing this. And with the form, they have to say what the purpose of it is, like what the hedging or like price discovery purpose of it is. They don't have to publish that. So they've confidentially told the CFTC, like someone somewhere is hedging some economic risk by betting same game parlays in a football game, but seems like a pretty marginal use.
There's like certain people in the world that I want to sit down with and like give them truth serum and ask them specific questions. And one of those people is probably Vlad Tenev. And I want him under truth serum to tell me like, what do you truly see in this prediction market that's different from just sports gambling or the founders of Kalshi? Those are questions that I would like to ask them. We could have
the Kalshi people on any time.
I know, but we can't give them truth serum.
I think they'd be pretty honest about it.
But I want to know if they truly, truly believe that there is a real substantial difference between a prediction market where you can offer single game parlays versus just sports betting.
Okay. One, no.
Yeah.
Two.
But I know that you think that.
Two, I think that what people have historically said about this is that there's a big difference between sports books and prediction markets. And that difference is that a sports book is on the other side of the bet from you.
Right.
And a prediction market is just a platform where people can bet against each other.
Faceless, emotionless.
No, it's not faceless, emotionless. It's a peer-to-peer platform. It's a place where I want to predict that the Bills will win. You want to predict the Patriots will win. We bet against each other.
Go Bills.
Kalshi brings us together. They provide a platform for us to bet, but they're not the bookmaker. They're not setting the odds. They're not taking the other side of it. They don't want you to lose. They don't care. They're just like intermediating between people on one side and people on the other side. They don't want anyone to lose. They're not trying to trick anyone. They're not trying to limit winning bettors. They're just bringing people together. Whereas a sports book is betting against you. So they want you to lose. They want you to bet a lot of money and lose. And if you bet and win, they will limit you so that you can't win too much money from them because they're taking the other side of every bet. I've always found this distinction overstated because like the way, for instance, Robinhood works when you trade stocks is nominally like you can buy or sell stocks. Robinhood is not on the other side of you, but like practically your orders are going to a market maker, right? Like modern markets have market makers who are taking the other side of you and they want, loosely speaking, to win, right?
Right.
And in prediction markets, it's a mixed bag. Like it is clearly the case that like small dollar prediction markets on like local elections, like Jane Street is not taking the other side of your bet on that, right? Like they really are peer-to-peer, right? Like some people are more professional than others. Some people have more capital than others, but like ultimately the prediction market is just a platform for people to bet against each other. With sports, it's not clear that's true, right? Like you have like some of the big market makers. Susquehanna has a big sports betting business now. The big market makers will like support sportsbooks or trade on sportsbooks. And like, it seems clear that some big market makers, you know, if there's a big enough demand to trade sports bets on prediction markets, they'll be on the other side of the sports bets.
Right.
So again, there's a market. You can take either side, but like a market maker will sit in between and try to take the winning side of the bet, right? And this is especially true with parlays because like the way a parlay works is like there's no natural person on the other side. Like if I pick like, here are the 6 things that I think will happen in this football game, and if I hit all of them correct, I win a lot of money. And if I miss even one, I get nothing. Like no person is taking the other side of that. No individual retail gambler is like, I want to predict that one of these 6 things will not come true. And if they all come true, I'll pay a lot of money. And if none of them come true, then I'll make a little money. Like, it's not a retail gambling bet. The person on the other side of the parlay has to be a market maker. And it's like not entirely clear exactly what the mechanics are, but like it seems like the mechanics are like there's a market maker with a pricing model. And like if you pick a parlay, you can get it sent to the market maker who will fill it for you at like a price that the market maker sets. And so that's different from everything else on Kalshi, right? It's different from the story of like, we're just a neutral platform where people can trade. This is clearly a story of like, you are trading with a market maker. It's not Kalshi. Kalshi isn't directly betting against you, but someone is directly betting against you who is partnered with Kalshi to provide this service, right?
Yeah.
Or maybe more than one somebody, right? Maybe there are a bunch of market makers who are providing the prices. But that's like pretty different and like much closer, not only in the product, but in like the structure to traditional sports betting.
So I see how, obviously from the perspective of Kalshi, that is a really substantial and meaningful difference. But
I'm saying they're getting rid of that difference by doing the parlays.
Well, I was going to say, like, if I'm an investor or a bettor, a trader on Kalshi versus a gambler on FanDuel, like, is my experience any different? Probably not.
Well, it's different in various ways. The news this week of Kalshi offering parlays like caused a big drop in the stocks of the traditional sports books.
Yeah.
Like, they both went down like 10%, like FanDuel and Flutter. But Kalshi is still like a teeny tiny fraction of the size of them because like they offer more bets and a better user experience and everything. But like that's converging. But is your experience different? Yeah. Like, I mean, like the buttons you push and like the sort of layout of the thing is different. But like, I don't know how big a difference it is that they're a platform and other places are sports books. Because I do think that like in either case, you're kind of facing ultimately some algorithmic price setter, some professional who sets the prices and tries to set the prices so that like the market is just like any other market maker. Like you want to have a relatively balanced book, right? You don't want to be facing a huge risk of, you don't want to be betting all on one side so that if you lose a lot of money. But like you take some risk. You're not looking for a perfectly balanced book, right? You're like looking to have some bets where you think the odds are in your favor.
Yeah. The fact that you did have those shares drop meant that sell-side analysts had to react to the news. And there was an article by the Wall Street Journal quoting this benchmark analyst, Mike Hickey, who made the same point that this is small. Until it scales or becomes more robust, it doesn't appear competitive. And it seems like DraftKings and FanDuel still have an edge. He also mentioned that the strategy by Kalshi to make themselves look just like a sports book certainly comes with some risks, which is interesting. I mean, you made the point that there's all this legal drama, but then the calendar flipped and it was January of this year. And now you're in Trump's America.
Yeah, I don't think they think it comes with that much risk.
Yeah.
Like, there's risk. Their court cases are still on appeal. Like there's still some risk that it will turn out that they're subject to state gaming regulation. And then basically this kind of goes away. Right?
Yeah.
Like not entirely, but it kind of goes away. But
well,
I think they're very strongly betting on in Trump's CFTC, they can do whatever they want and no one will stop them.
It's funny because DraftKings, the CEO apparently has specifically cited Kalshi's legal troubles as part of the reason why that they've steered clear of prediction markets. But I think they should fight back. They should launch their own prediction markets and go for it. Or they should offer stock trading. Why not?
Offering stock trading is actually a separate set of questions
yeah,
from
that's probably
whether prediction
too far,
markets are gambling. I think if like Kalshi ultimately ends up a really big competitor to FanDuel and DraftKings and the legal stuff is all resolved in favor of like you can offer whatever bets you want on a prediction market, then Kalshi has a huge advantage. They're legal in 50 states and it's not free from debt, but they seem to get a better tax treatment. Mm-hmm. And so I think FanDuel and DraftKings flip into finding a prediction market, right? I think it's hard, right? They have to register with the CFTC, but it's there's a path to doing it.
FanDuel did it, and apparently
sort of. They partnered with CME for But yeah. I've written.
Go on.
And this will be of interest to you. That within the next 2 years, we're going to see a football bet ETF.
You're right.
We can end it here.
Yeah.
And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on the close between 3 and 5 p.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question, and we might answer it on the air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Ondam. And special thanks this week to Cal Brooks.
Our theme music was composed by Blake Maples.
Amy Keene is our executive producer.
And Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.